All right. Hello, everybody. Hope you're having a great Christmas. Just wanted to check in and share a video on one of the best performing banks that I have ever seen, EQ Bank. So, if you know me, I'm a dividend investor. I love my Canadian and US large cap banks, those being the JP Morgans, the Bank of America, TD, Royal Bank, National Bank, etc. But this bank here, EQ Bank, has just crushed them in terms of total shareholder return or performance over the past 10 years. So I wanted to share my thoughts on EQ Bank in this video. So without further ado, let's go and dive right into the video. So this chart right here shows the total 10-year shareholder return or compound annual growth rate for each of the largest banks here in the TSX or the Toronto Stock Exchange in Canada and the S&P 500 in the US compared against EQ Bank. So as you can see here, EQ Bank has returned roughly 14.5% per year over the past 10 years. Now remember, this is total shareholder return, so that is the dividend and the stock price appreciation. Now, when you look at that compared to the other banks, you got the big ones here, JP Morgan Chase in the US, Morgan Stanley, National Bank, Royal Bank, TD Bank, Goldman Sachs, Bank of America, Bank of Montreal, Bank of Nova Scotia, and again, US Bancorp, Wells Fargo, etc. here. These banks, in terms of their performance, pales in comparison to EQ Bank. So this is one of those great companies that I believe is one of those gems or diamonds in the rough. And to be honest, I had never really heard of this company until about 5 years ago, and I just started using their services about a year ago. I really like their services as a consumer, and I think that in terms of an investment, they could be a great pick here as well. So let's go and dive a little bit deeper into this great performer, EQ Bank. So looking at EQ Bank, we'll have a look at their investor fact sheet and we'll see who they are, why we might want to invest into them, etc. So when we look at who they are, EQB Inc. or EQ Bank serves more than 578,000 customers in Canada. So again, remember, this is only in Canada through its wholly owned subsidiary, Equitable Bank, that also supports Canadian credit unions and their 6 million members. So the bank's purpose is to drive change in Canadian banking to enrich people's lives. So that's basically their mission there. It was founded more than 50 years ago. Canada's Challenger Bank, trademarked here, so they call themselves Canada's Challenger Bank, offers distinct, diversified personal and commercial banking products and lending services through its EQ Bank platform. So again, this is a online bank, online, no branches, low overhead. So I'll continue. The bank has been named the top Schedule 1 bank. So again, a Schedule 1 bank, so super reliable bank here, for 3 consecutive years by Forbes World Best Banks in 2023, 2022, and 2021. That is a great title to be named by Forbes here for the past 3 years. So when we look at their key metrics, and again, this is of their most recent quarter ended or their Q4 2023, total assets under administration or assets under management, AUM or AUA, roughly 111 billion, total assets of 53 billion. Now their ROE or return on equity, 15.8%, and adjusted is at 16.5%. So great return on equity here for a bank. Their CET1 ratio, so again, this is their CET1 ratio at 14%, so higher than the required by the other large or Schedule 1 banks. And their book value per common share, or BVPS as it's called, is $70.33. So reasons to invest into this bank. So again, they have a proven track record like we saw when we looked at their total return. They have a history of delivering long-term shareholder value. 16% plus average return on equity over the last 10 years. Now, they are the largest digital and mid-sized bank in Canada. So the 7th largest independent bank by assets, with over 95% of their deposits being term or insured deposits. So that's great to know. Innovation and sustainability. So they're leveraging cloud-based technology for people and businesses with leading environmental, social governance focus and metrics. So again, if you're unfamiliar with the banking system here in Canada, we have a lot of bank branches, not a lot of changes happened in the banking system, I would say within the past 100 years. But here, EQ Bank, as they call themselves the challenger bank, they're focusing on more technology, cloud based platforms, helping people and businesses. And again, they don't have branches, it's all online here. Focusing only on Canada. So all loans under AUA or under administration or under assets under management are in Canada, and almost 100% are secured and 52% are insured. So again, not very diversified in terms of where they're getting their loans, but this could be a good thing as well. Focusing just on one specific country, Canada, if they develop that niche properly, that could actually be a great advantage. And I guess it has proven to be for the past 10 years for EQ Bank. As they focus only on Canada, they know the country well, they know the geopolitics, they know the regulations, they can continue to shine in Canada. Now, again, the negative being if they focused on other countries, just not Canada, but if they focused on the US, for instance, they could diversify their revenue streams. But this has seemed to be working for them in the past. And again, if this is the niche that they operate into, that could actually be a good thing. So it all depends on how you look at that Canada only focus. All right, so this is a breakdown of their LUM, or their loans under management. So as we can see here, it's split up roughly 30 billion each here in the loans under management, and this is their deposit mix, so another 30 billion. So 60 billion here in loans. Now 32 billion coming under personal banking and 30 billion coming under commercial banking. So under the personal banking, roughly 60% are uninsured single family mortgages. 33% are insured family mortgages, and you have a couple decumulation loans or consumer lending here, nothing really significant. Look at that commercial banking. 67% of this commercial banking loans under management is insured multi-unit residential mortgages. So that's great. A focus on insured multi-unit residential mortgages. So a nice cash flow for investors who own these multi-unit residential mortgages, multiple units, and therefore diversifying their loans under management here. 20% commercial finance group, and then you have some equipment leases, specialized finance. Again, nothing significant here. The deposit mix, you have broker deposits at 55%, EQ Bank deposits at 26%. Credit unions, they just acquired a credit union, so that's 8%, and then they have a couple of bonds and deposit notes here as well. So let's scroll down a bit, and let's look at EQ Bank. Again, like we saw, it's a digital banking platform, and it's the first to move to Canada as a cloud-based platform, continuously expanding their product offerings, including the recent launch of the fully digital FHSA, or the First Home Savings Account, in July 2023, and rated 4.7 out of 5 in the Apple App Store. They do focus on ESG. Now, I want to look at these numbers actually a little bit more in detail. So let's look at the credit ratings again by the various credit rating agencies. They give them a pretty high rating. So again, triple B here in terms of the long-term issuer rating. Short-term, they have a rating outlook as stable, covered bonds as AA here. Now the shareholder information, market cap, so 2.6 billion, so they're a smaller capitalization company. The share price here was $68.82 when it was closed, but again, it's risen up significantly after they released these results. We'll have a look at that later in the video. 10-year annualized shareholder return, 12.7%. Dividends, $0.38 per common share that was declared. Common shares outstanding here is 38 million. They trade under the ticker symbol EQB. So looking at the customers and deposits, and then the dividends. So this line here representing the customers in the thousands and the deposits of those customers in the billions. As you can see, there's just a straight line up, and they had very significant growth right after COVID. A lot of people recognizing their product, and actually me as well. After COVID, I actually signed up as a customer, and I love their products. They offer great products here, very nice high interest savings accounts and checking accounts, totally free. So again, their deposits have ballooned from roughly 1.1 billion in deposits in 2016 to 8.2 billion dollars in deposits here. And again, with those deposits, their customers have also grown from 27,000 to 401,000 here in 2023. Again, with this growth, they've also continued to grow their dividends. They've been growing their dividends from 2016 to 2023 at a 20% compound annual growth rate per year. That is huge dividend growth. So again, the dividend was smaller, but they have been growing this significantly over the past 7 or 8 years. And I don't see a reason why they won't continue to do that. So great dividend growth here. And we'll look at that when we look at the financials in a minute as well. So when you take a step back and look at the mix of the assets and deposits over the past 10 years, you can really see the growth here from that perspective. Now remember, the deposits are what banks need in order to conduct business. They take your money, they from your deposit account, and then they loan that money out and they earn interest on those loaned funds. And the difference between those that loaned interest that they make in terms of revenue and the interest that they pay out to you is their profit. So looking from 2013 to 2023, we can see their deposits have 5 times. So from 6.4 billion up to 31.6 billion now. And when we look at the personal loans under management, we can see that has also 7 times here. So again, great growth. And when we look at the commercial loans, those have 4 times. So very solid growth here, in my opinion. So let's look at the financial results. So again, this is just an overview, and this is comparing what they guided to for 2023 and what they actually achieved. Now, as you can see, spoiler, they achieved all of them, but they guided for 16% return on equity. They got 17.1%. The pre-tax profit or income, they guided for 490 to 520 million. They actually beat that at almost 530 million. Diluted earnings per share, they guided between $9 to $9.20 per share. They beat that and got $9.40 per share. Dividend growth, they grew it at 24% here. Book value per share growth, they grew that at 12% here, coming in line with their estimate. And then their CET1 ratio, 14% above that 13% plus range like they expected. So solid financial results, beating or coming in line with all of their previous guidance for the year. All right, so when we look at them in terms of the quarter compared to the year over year, we can see much more of the same. Return on equity at 16.5% for this quarter, diluted earnings per share $3.80, and the growth rates are here as well. Book value per share, so again, this is a bank, like I said, we're looking at the BVPS or the book value per share, roughly $70 and growing year over year at 12%. So nice growth here, in my opinion. All of these, again, great growth rates. It's just surprising to me how this is a bank and it's growing at such high rates. Again, this is a smaller bank, so a smaller bank can grow, but their product offering in terms of the offering that they make to their clients, again, like I said, the various products, the FHSA, the high interest savings accounts and checking accounts, no fees, moving and leveraging that technology has allowed them to grow at these significant rates. So as you can see, very strong growth numbers in terms of net interest income, total revenue, again, net income after tax, just growing at very high rates here, in my opinion. So that was a look at some of their slides. Now let's go and look at Stock Unlock. All right, so looking at Stock Unlock, and I like using Stock Unlock, looking at different metrics. I'll leave a link that if you do like Stock Unlock or how I've presented it, you can sign up. Again, leave a link in the description below and in the comment section below as well. And an FYI, if you do sign up, I do get a referral fee just for your information. So EQ Bank here trades at $86.78. And when we look at the stock, it is, it's been very volatile, but it has grown at such high rates, again, in line with the growth of the business. And when we look at it over the past month, again, it's just gone up with everything in the stock market, but it has performed significantly well here. And when we look at some of the key data and metrics, we can see it's a $3.29 billion market cap company, operates in the banking industry, earnings per share as $9.12. The price to earnings here, a reasonable $9.51. And we look at the forward price to earnings or PE, 6.87. So again, not a super expensive company on a current PE and on a forward PE for the type of growth that it has shown. Dividend yield here, nothing to write home about like the other banks. The other banks offer 4, 5, 6% plus dividend yields. This is a lower dividend yield, focus more on growth. as this company has shown. So 1.84% here as a dividend yield. And we look at the price to book, 1.16. So again, trading at a higher valuation here. Usually looking at banks, you want to look at them trading around a 1 price to book traditionally. But this does have an earnings yield of 10.52%. And as you can see here, the low payout ratio, dividend payout ratio of 17.53%. So let's go and look at some of their financials. So when we look at their financials, we're going to be looking at their income statement and total revenue. As you can see, like we saw, it has just continued to grow year over year. Just great revenue growth here, in my opinion. If we scroll down, like we know, revenue is not the end all and be all. We want to see that revenue translate into net income and earnings, and more of the same here. As you can see, continued strong growth here over the past 15 years, in my opinion. Now scroll down and let's look at that earnings per share. Again, great growth, all falling in line with that revenue growth, that net income growth, and those earnings per share growth as well. So let's go and look at the dividend. So the dividend yield, like I said, is a low 1.84%. But when you look at the compound annual growth rate of that dividend, it's 24% per year over the past 5 years. So huge dividend growth. And when you look at that payout ratio, low 17.5% payout ratio. Looking at other banks like the ones in my portfolio, TD, National Bank, they have payout ratios in the low to mid 50s. So again, they pay out a more significant dividend, but they cannot grow it at such high rates. TD just increased theirs by 6%, but as you can see here, EQ Bank continues to grow their dividend at 24% per year because they have that low payout ratio. Now, when you look at their total returns, and again, I can span this out a little bit more from when they basically started, but basically EQ Bank here in the light blue is the performance compared to the S&P 500 in the dark gray. It's basically double the performance of the S&P 500, 660% compared to the 340% there. So again, huge outperformance here by EQ Bank. And this is a bank. Please remember, this is a bank. So historical dividends per share, as you can see, again, growing in line with those growth rates, just huge dividend growth here. And then again, that is represented by the historical yield on cost here. So this is a great bank like we saw. And again, I guess the question is, am I buying it? Am I buying this bank right now? And when you go to my portfolio, so opening my portfolio spreadsheet here, we can see that I do like Canadian banks. I am a Canadian dividend investor. If you're familiar with my portfolio, you can see I have about 6% in Canadian banks, and this is actually made up of TD Bank here at 3% and National Bank at almost 3% here. I do like these banks. The only reason why I'm not buying EQ Bank right now is because it's trading at this $86 mark here. So it has seen, like I said, over the past month, significant gains in the stock price. Again, these are warranted. Like we saw, they had great results. Again, it is a great growth story here. But for me, when I'm looking at buying a bank, I usually try to buy it when the price to book ratio for a bank, because that's how you value banks, is near 1. So again, in my opinion, I think it's a little pricey here because it has run up along with everything in the stock market. So I would like to get it closer to that book value that we had seen before. And when we go to look at the book value per share, it was roughly $70.33. Again, I'm not sure if I'll be able to get it at that $70.33 mark because it is such a quality business. So if I do see any price declines, anything under 80 or so, I might start to begin a position or dollar cost average into a position. I'm just looking for it to kind of lose some of this steam so I can get a margin of safety. But again, trading at a 9 price to earnings ratio and a forward of basically 7, that's not super expensive either on a PE basis. So again, I could probably average here. This is a quality company, and I could start a position or buy into a position here in dollar cost average on my way down. So I may do that as well. It is not super expensive here when you look at it on a PE basis. I would just rather buy closer to a 1 price to book ratio, but we'll see what happens. We never know. Prices for stocks have gone up. They have continually increased over the past couple of months. So they could kind of go back down in early Q1 of 2024. I'll just have to see and possibly buy into this. It's definitely on my watch list. I would like to add this bank, maybe half a position or a full position, all depending on what the price does over the next couple of months. Now, what have they guided for in the future? So, looking ahead to their 2024 guidance, it's great guidance. Again, just in line with the past couple of years, 15% ROE or return on equity. They're guiding for diluted earnings per share of $11.75 to $12.25. That dividend continuing to grow at those 20 to 25% rates. Book value per share growing 13 to 15% again, and keeping that CET1 ratio super, super high. So this is a great company, again, growing just very, very significantly. So it might not be a bad idea to buy an average into this one. Uh, Again, I'm just going to be a little bit more selective with my price targets. Like I said, I don't think it's super expensive right now, but I don't think it's super cheap either. It's kind of reasonably, you could say it's kind of fairly valued, but again, I'd like to get it closer to that price to book of $70 or $75 if I could. So we'll all see what happens. So that was EQ Bank. I hope you enjoyed the video. If you did, please leave me some comments in the comment section below and let me know what you think about this bank. It's a great performer, and I'd love to hear your thoughts. So with that one, I will see you in the next video. Thank you. Have a great day. Bye. Please note, I am not a financial advisor by any means. All this content is merely for your entertainment and educational purposes only. Please do your own due diligence when investing in stocks. Stocks are inherently risky and you can lose money. I am not liable for any investing decisions or losses you may incur. Thank you. Bye.